Okay, the next subtopic, profit and loss statement. What is a profit and loss statement P&L? Profit and loss statement P&L is a financial statement that summarizes the revenues, costs, and expense incurred during a specified period, usually a fiscal quarter or year. P&L statement, also synonymous with the income statement. Many refer P&L statement as a statement of profit and loss, income statement, statement of operation, statement of financial result or income, earning statement or expense statement. What is a P&L statement? P&L statement provide information about a company's ability or inability to generate profit by increasing revenue, reducing costs, or both. Understanding a profit and loss statement P&L. Profit and loss statement is one of the three financial statements every public company issues quarterly and annually, along with the balance sheet and the cash flow statement. It is often the most popular and common financial statement in a business plan as it quickly shows how much profit or loss was generated by a business. It is important to compare income statement from different accounting periods as the change in revenues, operating costs, research and development spending, and net earning over time are more meaningful than the number themselves. The basic formula for the profit and loss statement is revenues minus expenses equal to the net profit. P&L statement generally follow this format. First, revenues minus operating, which is variable expenses, equal to gross profit, operating margin. Second, gross profit with operating margin minus overhead, fixed expense, equal to operating income. Third, operating income plus or minus other income or expense that is non-operating, equal to the pre-tax income. And fourth, pre-tax income minus income tax equal to the net income, which is after tax. The definitions of these categories. Revenue is the money you receive in payment for your products or services. Operating or variable expenses are the expenses that rise or fall based on your sales volume. Gross profit margin or operating margin is the amount left when you subtract operating expenses from revenues. Overhead or fixed expenses are costs that don't vary much month to month and don't rise or fall with the number of sales you make. Examples might include salaries of staff, office staff, rent, or insurance. Operating income is income after deducting operating and overhead expense. Other income or expenses not operating generally don't relate to the operating side of the business, rather to how the management finance the business. Other income might include interest or dividends from the company investment. For example, other expense might include interest paid on loan. Pre-tax income is income before federal and state government take their shares. Income tax. How income tax is shown on the P&L varies based on type of legal entity. For example, a C corporation almost always shows income tax expense, but S corporation, partnerships, LLCs, and sole proprietorship rarely show income tax expense on the P&L. Lastly, net income after tax is the final amount of most profit and loss statement. It represents the net total profit earned by the business during the period above and beyond all related costs and expenses. And lastly, the profit and loss statement example. The operating revenue. The product sale is $12,000 plus the service sale $3,000, with the total operating revenue is $15,000. For the operating expenses, cost of goods sold is $7,000, while the gross profit is the total operating revenue minus the cost of goods sold, and get the $8,000. For the overhead, rent is $1,500, insurance of $250, office supplies with the $150, and utilities of $100, with the total overhead is $2,000. Operating income is $6,000 after the gross profit minus the overhead. Ada income expenses, loan interest, which is $500. Earning before the income tax is $5,500 after the operating income minus the other income. Income tax with the $500, which cause the net earning to be $5,000.